You want to know what are the best stocks to buy. Now I've got 7 stocks that I'm buying right here at these levels and lower. Let's go. The first stock is AMD, and I think this is one of the most attractive stocks in the market right now when you look at the price and the growth. This last quarter wasn't that bad. I mean, data center revenue soared 94%. Of course, they are not doing very well compared to Nvidia when you think of GPUs, but I look at AMD really as the CPU player, that dominant CPU player in data centers. If you look at the hyperscalers, AMD has a market share over 50%, and Microsoft and Meta are both using GPUs from AMD. The main reason that AMD struggles against Nvidia is because of that software ecosystem. So AMD is unlikely to make big inroads against Nvidia anytime soon, at least in the GPU market. But when you think of AI inference and CPUs, AMD is going to be a major player. In 2025, EPS, earnings per share, projected to be $4.70, rising to $6.34 in 2026. I think if you buy this stock at these levels and lower and you hold the stock for a couple of years, you're going to be very happy. In fact, if you look at it right now, the forward PE is 20.55, very reasonable for the growth. Now, of course, there are worries and there are headwinds such as inventory, tariffs, and more. Now, for each of the stocks today, I'm going to look at the fundamentals, some of the financial metrics, as well as a chart. The profitability rating is at A- for AMD, 53% gross profit margin TTM. The growth is very strong, again, for the valuation, about 19% here in the forward revenue growth. So that 20.55 is non-GAAP. Of course, the GAAP forward PE is at 38, so it's not as cheap when you look at that metric. But when you look at things like PEG ratios, it's really not too bad at all. You know, generally speaking, anything under a 1 is very attractive, and this is a 1.09. Looking at a chart, you guys know the story. We trimmed this when it was $200 plus. Said it was overvalued when it was even $150 plus. Told the community on chart day, thought the stock was worth $100 to $105 when everybody was thinking that, hey, AMD is going to take over Nvidia. I want to go against the grain here, and I want to DCA AMD under $100. Of course, the stock can go lower. This S2 Fibonacci is 93.06. And the S3 Fibonacci is 84.97. You could see 70s or even 80s on this stock, especially if the entire market washes out or if you have a recession. But I bought some more today under $95 a share, and I'll continue to add to AMD at lower levels. In fact, I've been DCAing up. So in other words, paying more than my cost basis. My cost basis is under $75, and I've been adding at these levels. The second stock on the list today is Oracle, which just reported earnings last night. Now, Oracle Cloud Infrastructure partners when you think of Nvidia and OpenAI for Stargate. Some of the numbers were pretty staggering last night on the earnings report. Even though the revenue and EPS wasn't as good as it could have been, some of the growth within cloud was pretty amazing. Of course, Oracle is a database leader, and if you don't think they're going to continue to be a leader, you could look at MongoDB, which is also beaten down right now. But the potential here for future cloud growth in AI, tremendous when you look at profitability metrics. This isn't going to be hyper growth. It's much more of a mature company. I would consider Oracle a DGIF stock. In fact, it just raised its dividend by 25% last night to 50 cents. That gives you a forward yield of about 1.34, a little bit higher because the stock is down about 5% today. So the stock was down a little bit more this morning. Oracle's bookings and cloud strength helped Wall Street to look past the choppy Q3. Larry Ellison from Oracle on the earnings call last night said that our database multi-cloud revenue from Microsoft, Google, and Amazon is up 92% in the past 3 months alone. GPU consumption for AI training grew 244% in the last 12 months. This is very bullish for Nvidia. And that's another stock, if Nvidia, if I didn't have a $3.94 cost basis, I'd be buying it under $105 today. Could it go below $100? Absolutely. But look at some of these metrics from Oracle, up 52%, up 49%. So remaining performance obligations, $97 billion. Now, some of that could be at risk if Stargate doesn't spend all that CapEx. But Oracle's target fiscal 2027 revenue has growth of about 20%. Again, this is not hyper growth, but it's going to give you that dividend, and I do think it'll outperform the market over the next 3 and 5 years. So you can see this red trend line. It came down and kissed that trend line. Very much algorithmic trading. It's a little bit higher right now at about $142. I like it in this range. I prefer it really 150 or less DCA, but of course, the lower the better. My next buys are in at $139.97. This previous S3 is about $131 and change, so you've got pretty good support, I think, around $130. The next stock that I'm buying, number 3, is Arista Networks. The ticker is ANET. So this is going to power AI workloads for companies like Microsoft and Meta. This last quarter had data center revenue growth 17 to 25% from hyperscaler spending. Now, of course, all this, the whole AI thesis is at risk if CapEx gets cut. But this does have high profits, 52.5% free cash flow margin and 42% operating margin. It does have a premium valuation, but it has come down since that 35x. Very solid profitability metrics, A+, 64.13% gross profit margin TTM. The growth is very solid. Again, though, it's not going to be hyper growth, but 19% is very solid. Valuation, it's still not dirt cheap. It's trading right now at a 32.97 forward PE ratio gap. But again, you've got this PEG gap TTM. So this PEG ratio is below a 1. So that means this company is growing into its valuation very quickly. And this is what you want as a growth investor. You can see the stock is up 16.42% in the past year. Now, the high on this, $133.58. So it's dropped from $133 to $78 today. Now, looking at the chart here, you can see it's broken down from that 133 into the 70s. So we've broken past the 50, the 100, and the 200 simple day moving average, as well as that red trend line. Also below the Fibonacci S2. The Fibonacci S3 is just below $70 at $69.48, which is a possibility. I like this stock, especially $75 or less DCA, but even in these levels here. Now, this next pick is really about diversification and energy play, and it's still going to give you exposure to AI and data center. Of course, we know we have huge AI energy demand, and Constellation's nuclear power fuels AI data centers with deals like Microsoft driving growth. Now, part of the reason the stock is down is there's rumors out there that Microsoft has canceled some of these leases. We also had tariff news today about energy in Canada, but I'll show you a chart here and just how bad this stock has been beaten down, and it's pretty attractive at these levels. So you've got the nuclear revival, earning strength here, pretty solid. Valuation upside, it's trading, at the time of this, it was trading at 30x forward PE, and it has come down some, but it was supported by 130% earnings growth in 2024, which is unheard of for an energy company. And this is a clean energy leader, the largest US carbon-free energy producer, primed for AI and sustainability trends. And you can see here, this author recommended this stock as a strong buy at $313. It's down 34% since this publication. The profitability, of course, isn't going to be nearly as high for what this company is. Valuation-wise, PE gap forward 21.41. But again, look at this PEG ratio. The TTM is 0.12. Forward price to sales 2.73. This was a $352 stock, and it has fallen off a cliff. It's up about 22% in the past year, but it's come down a lot. And Constellation does pay a small dividend as well, 0.77%, so it could fit in that DGIF basket. Market cap is $63 billion. And looking at a chart, a lot of these stocks look very similar. So above $350 a share, dropped off a cliff. In fact, it got down as low as $195 a share. So you can see it's below, again, the moving averages, the trend line, the S2 Fibonacci. This S3 is 185.74. I like this stock below $200 DCA. In fact, I was buying it a little bit higher. I think I'm down about 3% overall with my total cost basis after using dollar cost average. The next pick is Qualcomm, and I like this one a lot when you think of AI and the edge. Their Snapdragon chips are really a leader when you think of device AI, powering both smartphones as well as PCs. This last quarter is very strong, 18% year over year, driven by AI and automotive. This does pay over a 2% dividend yield. Really is more of a DJI stock, but it's kind of in between DJIF and DJI. We had a profit surge, $3.41 beat on estimates. I'm surprised this stock isn't higher than it is. At the time of doing this slide, it was 17x forward PE, and analysts see a 30% plus rise to the $204 target. Well, of course, now it's a $150 stock. This is important because Qualcomm could lose some of its business to Apple, but it has a diversified future, $22 billion non-handset goal by 2029, led by AI, Internet of Things, and 5G expansion. So 2.19% dividend yield. It's down 11% in the past year. $171 billion market cap. This was a $230 stock. Now you can get it for $152. Profitability, very strong. A+, 56% gross profit margin. The growth is solid for what you get, going to be around 10%. And the valuation, if you look at this, the gap forward PE is only 15.86. and that peg gap is 0.52. So when this stock was over $200, anything you see in orange is a previous chart day we do every single Wednesday in Patreon Discord. I said, hey, I wouldn't touch this thing over $175 when people were paying 200 plus. I circled this orange circle and said, this is the area I'd focus in. It did get down to $149, and today it's just kind of teasing that 150 level. This S3 is down here at $138.92, so it certainly could go lower. I like this stock, $150 or less DCA. The next one here is CASY's, and be careful because they do report earnings in the morning, so it could fall. It would be an opportunity, I think, if it did sell off of earnings. If you're from the Midwest, you know that these things are everywhere. They've built 4 of them just around me in the last couple of years. One of the largest pizza chains in North America. The last earnings was very strong. Of course, what's going to matter is earnings tomorrow morning. Now, this stock actually has been outpacing the S&P 500 since September. Of course, it's come back a little bit, but it's held up pretty well compared to a lot of other stocks. Of course, this is not a technology name. We're talking about 2,600 plus locations, plus that Texas acquisition to give you more future gains in fuel. And one thing I like about CASY's is how it's vertically integrated. They sell their own chips and snacks. If you've ever been there, you know exactly what I'm talking about. They also have their own bakeries, pizza shops, and more. So we're talking about gas stations, convenience stores. So the profitability is not going to be as high as, you know, a software company or something like that, but pretty good overall. Not going to be huge growth right now, but I do think you'll see some acceleration. Valuation wise, it's not cheap. People pay a premium for it. So this is one that you might want to avoid because it is a 27 forward gap PE. And that peg is 2.10. Of course, you want that thing closer to 1. This stock was almost $450. You can see it's up 26% in the past year. It has a small dividend, 0.52%, so it's a DGIF play. The market cap is only $14.17 billion, so I think there's tons of room for growth for CASY's. Looking at a chart on CASY's, you can see the drop from 445 to 375. It's below the moving averages. It's also below the Fibonacci S3. If earnings miss, you could see this down, 350 to 360. I think it's going to be a buy if it does sell off more. I've been buying these levels today around $375 a share. Now, with all these stocks, I always save room to buy more shares if it goes lower. Dollar cost averaging works great, but you have to know how to do it. And let's just say that you're trying to buy some of these names, but you don't really know what to buy, and you want to build up maybe some ETFs in your portfolio. So SCHG, Tech Titans here with Apple, Microsoft, Nvidia, and more. This is going to track the Dow Jones US Large Cap Growth Index, and it's prime for future upside if you're looking to hold this for 5+ years. You can see Apple's largest holding here, 11.39%, then Microsoft, Nvidia, Amazon, Meta, Broadcom. It also has some Eli Lilly, some Alphabet, some Tesla, and a lot more. You can see just how diversified it is. It starts to get into United Health Group and MasterCard and Visa, Costco, Netflix, GE Aerospace, Adobe, Intuitive Surgical, and many others. Another one that broke through all the moving averages and the Fibonacci S3. I like this a lot. $25 or less DCA. If you're new here, make sure you subscribe to the channel and smash that bell to get notifications so you don't miss the next video. And if this video was helpful, return me the favor. Drop me a like, drop me a comment. Have a great rest of your day. Take care.